Today I'm going to talk about director's loans. A lot of accountants are recommending that clients start Division 7 loans. If you operate a company, these are pretty popular, but in most circumstances I really don't recommend that we do that, and I just want to go through and explain why. When you operate a company, the company trades, it owns the income and the cash that it generates from the business. So the company pays you a wage, it pays all the workers a wage, including the owners, for the work that you do. It's called wages and salaries. When you take money from your company, you should be sure to record it as wages with pay-as-you-go tax withheld. If you take funds from your company and you don't record them as wages in the wages system, they're treated as director's loans. Now, these are hugely problematic, particularly if they're not dealt with correctly, and they're taxed at an effective tax rate of up to 74%. Let me explain more. The ATO requires that these loans are treated as unfranked dividends. So essentially, the company forgoes a tax deduction of 25%, and the individual receives the dividend and has to pay full tax on that without an imputation credit of up to 49%. Now, we can prevent the loan from being treated as an unfranked dividend if we enter into a complying loan agreement. Essentially, we're putting that loan on commercial footing. Now, the ATO dictates to us the interest rate every year, and they publish that. They also dictate the amount that must be repaid, and generally these loans are paid over 7 years. So if you do this over several years, each year the loan is treated as a separate loan. It shows as a separate line on your balance sheet, and it's treated as a separate loan. So the benefits of Division 7A loans: in the first year, the year that you take the loan from the company, there's no tax. There's no tax at all. You can take $50,000 and there's no tax in year one. Now, the disadvantages of Division 7A loans or director's loans. Most often we pay a dividend from the company to cover the minimum repayments, and directors pay the top-up tax. So this is the difference between the company tax rate and the individual's tax rate. This happens every year from year 2 to year 7 of the loan. So the loans are generally over 7 years, and the individual who has taken that loan will have extra tax to pay for every year up to year 7 when it's repaid. The interest calculated on the loan is taxable income to the company, so you pay 25% tax on that, but it's not tax deductible to the individual who's actually paying it. Now, the substantial accounting fees are charged for the work on each separate loan. So every year there's a separate loan, and all of these calculations need to be made, and the dividends declared, minutes prepared at the end of the financial year. In fact, before the end of the financial year. And this is why accountants generally love Division 7 loans. It gives them something to do at the end of the financial year before the work really starts to come in for tax. Now, another disadvantage is that in the years after the first year, that is the years after you take the loan, clients all feel that they're paying huge amounts of tax. And they're actually right, they're paying lots of tax. I'm not a fan of Division 7 loans, but the clients that have come to me with them, by about year 3, often the business isn't generating enough income to pay the dividend, to pay the minimum repayments, and then we've got a real problem. So Division 7A loans might feel great in the first year, and they certainly make the accountant look like a hero with no tax, but they are a certain path to cash flow problems and can cause financial collapse. And that is why I really am not a fan. I'm not saying don't ever take a director's loan. In some circumstances you can. For example, a client who needed additional funds to buy his house. He wanted to do some improvements to the property before they moved in, and that was a perfect example. So we set up the loan for him, and he's paying that off over 7 years. But as a matter of course, as a day-to-day tax saving proposition, it's not a good one. All it does is kick the tax down the road. It doesn't save the tax still needs to be paid. You incur interest, which is not tax deductible, and you'll pay an awful lot of accounting fees keeping it up to date. And of course, it can also cause huge cash flow problems. So if you want to talk to us more about Division 7 loans, please just give us a call and we'll go through in more detail with you.